What if you could become smarter about money in just 8 minutes? Welcome to Money in 8 Minutes. Every episode breaks down an important financial topic into clear, easy to understand insights. Ready? Let's begin. Today, we're looking at a highly debated but honestly deeply fascinating perspective on global finance. We're going to objectively break down why one specific author believes physical precious metals are absolutely crucial for safeguarding your wealth. Okay, let's take a quick look at the roadmap for this explainer. We'll start with the fiat currency problem, look at the idea of a bubble in everything, explore the purchasing power myth, discuss a global paradigm shift, and finally touch on finding peace of mind. Section 1, the fiat currency problem. We're starting with the very foundation of the author's theory, which is the inherent flaw in modern money itself. The author actually argues that 99.9% of us simply don't realize we're no longer using actual money. We're using faith-based fiat currencies. Now, if you're not familiar, a fiat currency is basically national money that isn't backed by anything of physical value, like gold or silver. Instead, a government just declares, hey, this has value. And the author points out a pretty striking historical claim here. Throughout history, there have been thousands of fiat currencies, and literally 100% of them have eventually failed. Every single one. And this brilliantly illustrates the author's point about cyclical resets and global finance. The source material highlights that roughly every 30 to 40 years, the world hashes out an entirely new monetary system. We saw a massive system transition in 1922, the Bretton Woods Agreement in 1944, and then the complete abandonment of the gold standard in 1971. So following this exact pattern, the author predicts the current US dollar standard is developing terminal stress cracks right now, forecasting a major, unavoidable shift before the end of this decade. Section 2, a bubble in everything. So let's move on to the second theme to see how this builds into the author's warnings about other asset classes. According to this analysis, our debt-based global system has allowed unprecedented super bubbles to form across all major traditional investments simultaneously. It's like a giant house of cards. Just look at these points derived from the author's data. Stocks have allegedly been in an extreme super bubble since 1998, and that's citing data from Yale's Dr. Robert Shiller. U.S. Treasury bonds? Described as a dangerously bloated 30-year bull market fueled by artificially low interest rates. And real estate is painted as highly volatile, with institutional investment firms now holding up to 30% of post-2008 foreclosed homes. That creates the scary potential for them to suddenly dump thousands of homes onto the market all at once. There's a classic Wall Street saying that perfectly captures the psychology here. The bull climbs the stairs, but the bear jumps out the window. The source emphasizes that while human greed takes years or even decades to slowly inflate these massive financial bubbles, sheer panic can burst them in mere days. And fear, the author reminds us, is by far the more powerful emotion. Section 3. The purchasing power myth. This brings us to a truly fascinating historical comparison about the actual real-world value of gold. The source tackles a super popular financial myth that an ounce of gold has always historically bought a nice men's suit, going all the way back to a toga in ancient Rome. But the author asks a really compelling question here. Because humans mine gold at roughly the same rate we reproduce, there is roughly the same amount of gold per person on Earth today as there was back in ancient Rome. But thanks to factory farming and modern machinery, making a suit today is 1,000 times cheaper and faster than hand-weaving a Roman toga. So why isn't gold worth wildly more today than it was back then? Well, the author answers this by pointing out a massive shift in how humanity stores its wealth. Think about it. In ancient Rome, there was practically only one single liquid asset to store your purchasing power for the future: physical gold and silver money. Today, we have thousands of competing liquid financial assets: stocks, bonds, checking accounts, derivatives. The author argues that these modern paper financial assets are basically acting like a giant sponge, heavily diluting gold's relative value and totally offsetting those massive gains in human manufacturing efficiency. Now, to put that into perspective, check out this 20-to-1 ratio. The author calculates that today there is roughly $4,000 of liquid financial assets per person on the planet, compared to just $200 of investment-grade gold per person. That massive 20-to-1 disparity is the mathematical key to understanding the author's ultimate financial forecast. Section 4. A global paradigm shift. So, if a massive economic crash actually were to happen, the author theorizes the rush to gold would be unlike anything we've ever seen in recorded history. Why? Because the global playing field has fundamentally changed. Unlike the precious metals bull market of the 1970s, which was essentially limited to just North America and Western Europe, or about 10% of the world's population, today's market is completely global. In the 70s, we were a planet of savers. Today, following the tech boom and real estate bubbles, we are a global population trained to be active investors and speculators with roughly 10 times the currency supply floating around out there. The explainer's source argues that these aren't just additive factors, they literally multiply together. We are looking at 10 times the global population with market access, 10 times the global currency supply, up to 1,000 times more people with an active investor mindset. And crucially, for the first time in human history, all global currencies are fiat simultaneously. This creates a highly explosive scenario where thousands of times more currency could suddenly begin chasing a finite amount of physical gold and silver. So the mathematical theory presented here boils down to this. If just 10% of the wealth currently sitting in paper financial assets panics during a crash and shifts into gold, the sheer volume of capital would mathematically multiply the price of gold by 20. Section 5. Finding peace of mind. This brings us to the human element of this extensive analysis, explaining why the author actually takes these specific actions in their own life to prepare. Despite making some pretty extreme economic predictions, the author claims they aren't a pure doomsayer. Look at this probability breakdown. The author assigns only a 5% chance to a total Armageddon collapse, a 5% chance that no crisis occurs at all, but a massive 90% probability to a historic crash and market reset. They believe the outcome will land right in the middle of a probability bell curve. Yes, a massive financial crash, but one where humanity ultimately adapts, innovates, and bounces back with a stronger, more honest monetary system. Ultimately, the primary motivation here isn't just about scoring a massive wealth transfer. The author acknowledges the extreme tail risks, but actively prepares for that probable middle. They accumulate physical silver and gold to protect their purchasing power. They even maintain a supply of emergency food for their family and employees. The ultimate goal of all this? To relieve financial anxiety and simply sleep soundly at night. It's a calculated hedge against deep economic uncertainty. Whether you agree with these pretty dramatic economic forecasts or you're viewing them with a healthy dose of skepticism, this explainer leaves us with a critical question to consider about our own futures. In an increasingly complex, interconnected global economy, how do you view the balance between paper wealth and hard assets in your own life? It's definitely something we should all be thinking about. Thank you so much for exploring with me today, and I'll see you on the next one.